Hi friends, in the previous video we have completed derecognition and its effects. When it when it triggers, what is the variable consideration and how you treat that variable consideration, and also how to apply IND AS 115 if you transfer your PPE to inventory. So we have completed those. In this class, in the same previous class, we have completed introduction of IND AS Appendix A to IND AS. This is because if any liability changes due to passage of time or due to interest rate change or change in the decommissioning liability. If there are three changes, based on the changes, the treatment has to give under IND AS 16. This we will discuss in this class in detail, and then comparison with IND AS 16 to 10 and the IAS International Standard 16. So by this, if we complete this, we can able to say we can complete entire IND AS 16. The disclosure part you can read on your own, because most of the disclosure we have discussed in the classes. So let's begin today's class. Main of all, in the Appendix A to IND AS 16. This was introduced in IND AS 16 because of the decommissioning liability. The big idea is Appendix A applies where present value exists to determine, remove or restore or clean up or rehabilitate any site or asset in the future. Say suppose in the previous class I have explained what is the oil source for platform, government mining company and leasing improvements. In all these situations, say suppose oil company will use seabed. If it is a sea, they will use seabed to build this platform and restore these oils and export and import everything. So in this case, the plant the plant what they incurred here, so they has to restore its original seabed, restore to its original seabed. To do that, government has put the restrictions. After 20 years, you should do that restoration. So that is the decommissioning liability. Say suppose after 20 years your liability has to pay, and you have to incur to restore that asset or seabed what you used or cultivated during the period. You should restore that. So because of that, they gave one provision. Say suppose today the plant value is 100 crores and the restoration liability is 20 crores in the end. So this how we will account in general the PPE, both 100 crores plus restoration liability. The PPE value debit, I'm giving entry here. The PPE value debit 120 crore to liability or payable are paid 100 crores immediately we are paying or payable, and to decommissioning liability 20 crores. These 20 crores, say suppose this is the present value, the balance for these 20 years, year 1 to year 20, say suppose interest expenditure to increase of decommissioning liability for the interest portion. So this will give to the 30 or 40 crores at the end of the 20 years. So this is how you clearly account this transaction. We already discussed in the previous classes how we value PPE, but today we will discuss about liability. Why we are discussing liability in India 16 only? Because this liability arises due to PPE sources only. So because of this, they have introduced Appendix A in India 16 and India 36 also, because if it is any intangible asset, and also India 37 or 36, this is also regarding the recognition of the provision, because the liability is creating the provision here, right? So all this combined of these four standards, and this is also, and India is 116 if you put any sale and all. So all these transactions covering this idea of decommission liability, how you treat and all. So in the previous class we already discussed about these examples. I'm just revisioning this. The lease improvements also we have included here. Say suppose you have taken one building, newly constructed building for rent for 20 years. So later you divided cabins according to your business structure. So while you living after 20 years, this client, the lessor will ask you to please remove all your internal construction for my building. So you have to give my building as it is while I'm living. So you have to remove all this. So you should have to restore, or else all your lease improvements has to remove. So this is the liability for you. This is a contractual liability. This is the contractual liability. You have to remove at the end of the lease period in future. So that on that day, the estimated liability on that day is 40 lakhs. But if you want to account this on this day, the present value could be 12 lakhs if you calculate the present value. So the 12 lakhs will account as a leaseholding improvements today, and you will depreciate as per PPE in under India AS 16. And the liability, say suppose it's this present value of 12 lakhs added in the PPE debit side and credit side should be decommissioning liability. This decommissioning liability you should account till these 20 years. At the end of the 20 years, you will add the financial charges to decommissioning liability, and then you will arrive 40 lakhs or around 40 lakhs, and you will pay to the this restoration liability. So this is how you account in general. So this is the example we have given. The PPE cost is the PPE cost is 100 lakhs, and then estimated decommissioned liability after 20 years. Say suppose this is the present value only. So this is the 20 lakhs, and then discount rate we have used 10 percentage. The the present value is 7.7 lakhs for this 20 lakhs. So this is the where Appendix A will implement how to implement and all. So if you account this per PPE 10 plus 7.5 debit to bank or payable 100. So this 100 you have to pay immediately, and the decommissioning provision account under Ind AS 737 7.75. So the liability changes over the time. The 7.75 will changes. How will changes? There are three cases. One is change in the estimated restoration cost. Say suppose you have estimated 20 lakhs over after 20 years, but after 5 years, you know this cost has been required for only 15 lakhs, or this cost only required for only more than 20 lakhs, that is 25 lakhs. So again you will calculate the present value on the 5 after 5 years, and then check the commission liability by adding this interest, and then we'll see how will this account and all. So this is where Ind AS Appendix A16 applicable here. So the change is due to change in the estimated cost or change in the discount rate. You have taken this 10 lakhs, but 10 percentage, but later it has changed to 8% or 9% or 12%, either increase or decrease. So in this case your liability will decrease or increase. In this case also you should check the decommission liability provision, and how will account. But during the passage of time there would be some discount rate will increase. During the passage of time you have to charge interest, that could be the finance cost. So in these two cases the PPE will affect, and you will increase your PPE, increase your liability. Either decrease your PPE, decrease your liability. But here, increase your liability and charge to the finance cost. And also, there are two models here. Again, in these situations also, if any decommission liability is changing due to its original cost or its discount rate, you should check the PPE asset revaluation. I mean PPE value will change, but due to passage of time, if the increase is due to passage of time, this will charge you to P&L account directly as finance cost. But the change is due to these two situations. You should check the PPE increase or decrease. Again, here also, are we following cost model or revaluation model? If what we do if we follow cost model, what we do if we follow revaluation model, that we will discuss now. I hope you understand. This decommissioning liability change due to three, either change in estimations or change in the discount rate. These all are change in estimations only, and I'm just giving the separate because of the discount rate also there might be changes, or due to change in the restoration liability. These two, the PPE value will affect if the PPE value exits. But if this change is due to passage of time, right, passage of time means the liability has to pay the interest and all. So for this interest increase due to passage of time, you have to wind the interest, you have to incur the interest, right? So because of that, there is no PPE effect, directly finance cost to increase in liability. This is general entry. This we discussed several times in our previous videos. This is the one of the case that, but the main issue is these two. So suppose we are following cost model. First we see the cost model example. We are following cost model, and there is a change in the restoration cost. Okay, in that case, there is a liability after 5 years. The liability has been increased, that is 20 lakhs to 30 lakhs. We have increased our liability. Earlier we have taken 20 lakhs decommission liability, right? The present value is so and so, but now it has increased to 30 lakhs, and the present value for that increase is 3 lakhs. The 3 lakhs has been increased as on date. So generally 10 lakhs increased here, but the present value of 10 lakhs after this change makes up the asset value is 20 years, but after 5 years it has been increased 10 lakhs. The present value of 10 lakhs is 3 lakhs. So the liability has increased. So directly you can increase your cost because you are following the cost model, right? So you increase your PPE 3 lakhs to decommission liability increase 3 lakhs. So generally this will we increase. This how we increase, how we depreciate and all, we already gave one complete example in our previous videos. You can check through in the table also we have discussed this. You can check there. And then in the second case, the liability has been decreased from 20 lakhs to 15 lakhs. In this situation, the present value is 1.5 lakhs. The decrease is 5 lakhs, right? The 5 lakh, the present value is 1.5 lakhs. The decrease is 5 lakhs. The present value of the 5 lakhs is 1.5 lakhs. So your liability has decreased. So the entry is decommissioning liability decreased debit to PPE asset. Here, the change should affect the PPE value. I hope you understand. If any change due to decommissioning liability, due to change in the estimations or change in the discount rate and all, the change should affect the PPE value. I hope you understand. Or if something due to passage of time or interest, if any change, account we will account like this only. Interest account or finance charges to provision for increase. So this increase will keep on increase the liability. That there is no change in the PPE value, but they will change only. They will charge to the finance cost. Finance cost would be in the P&L account. But if it is a change in the restoration, they will pass these entries. If it is a cost model, if the liability increases due to restoration cost or discount rate, in this case, if any increase, the present value of that increase should add to P&L account, sorry, PP account, and then increase your liability. If any liability decreases, the change in the decrease will affect the commission liability decrease, and then decrease your PPE also. if PPE carrying account is less than the decrease. Say suppose here decrease is 1.5 lakhs, but this carrying amount of the PPE is 1 lakh only. So asset account cannot be negative, right? So in this case, say suppose the carrying value is 1 lakh, assuming these changes are in 19th year, not in the 5th year, 19th year. Carrying value is 1 lakh and the decreasing in decommission liability is 1.5 lakhs. So the debit decommissioning liability decrease is 1.5 lakhs to credit PPE. What is the carrying value? 1 lakh or 1.5 lakh, whichever is lower, 1 lakh only. So the PPE is 1 lakh. The balance amount is other income in P&L account 50,000. I hope you understand. So asset cannot be negative. You should show it as an income in the P&L account. I hope you understand this adjustment also. If the while you decreasing, while you it is in increasing in the increase case, it is not a problem. While you decreasing, if your value is if your PPE value is less than the decrease amount, you can increase you can affect that transaction to other income. Okay, and then if it is a passage of time, in the passage of time it's keep on increasing the interest, so interest account data to provision for liability. So if you satisfy the borrowing conditions situations, so say suppose if your plant is taking substantial time to get it used as per intention of the management, in that case you can account that interest as borrowing cost and you should capitalize under the borrowing cost concept. But under this in India's appendix is this interest should always to the P&L account if it is not satisfied the IND AS 23. Say suppose in the same example, but your carrying value is under the your PPE is under the revaluation model. In the revaluation model, I am just changing the example. If your PPE is already carrying at fair value under the revaluation model, because you always revalue your assetting the asset valuation, right? So you are always in the revaluation model, you are always in the fair value. So where does any change in the decommission liability will goes to revaluation surplus or P&L account based on the situation. Say suppose the revaluation surplus is exists on that day, the surplus value is 50 lakhs, but your liability increases 20 lakhs. Say suppose if this 20 lakhs is also present value, actual liability will increase maybe 40 or 60 lakhs. The present value of the liability is 20 lakhs. In that case, instead of increasing your PPE, because the PPE is valued already at fair value, because of that you should affect this increase to revaluation surplus account first. So the increase in the liability debit to revaluation surplus account. This in the same case, if the revaluation surplus is only 5 lakhs, in that case you should debit the revaluation surplus 5 lakhs. The balance account debit is P&L account, not to the PPE, because the PPE is already valued at fair value in the revaluation model. In that case, the increase is directly lost to you. That loss should you recognize in the P&L account. The provision should have to increase the liability. Say suppose in the same case, you do not have a revaluation value account, surplus account, or your surplus account is very less or nil, or else PPE is already carried at fair value, even though if any no caution to observe the increases, because you cannot increase the asset more than the fair value or other case due to change in the decommission liability. In this situation, you can directly hit the P&L account if any increase or decrease in the liability. If it is a decrease, it could be other income or add to the revaluation surplus extra. If it is an increase, it would be the P&L account effect only. So even when asset is carrying value is zero or useful life is zero and the decommission liability still exists, any further changes in the provision as to direct P&L effect only. There is no PPE carrying value left in the adjust the books. So suppose the carrying value is zero, but the decommission liability is still as a value. But if any change or increase or decrease, you directly go to the P&L account because the carrying value is 0. You should not increase the carrying value because of this liability in the PPE model, in the revaluation model. Or in case fully depreciated, the asset is fully depreciated, you are not using that asset, but your liability still have under the construction liability or legal liability. You still maintain that liability, but you should give that effective P&L account if you do not have a surplus account exists and there is no revaluation surplus or there is a less revaluation surplus, you can introduce the P&L account concept in it. So I hope you understand. While you decommissioning the liability, uh, first we need to check, is change due to change in the decommissioning liability value, due to the change in the estimates, or due to discount rate, or due to passage of time. If it is a passage of time, it is just a finance cost. If it is due to change in the estimates and all, then we need to see, are we following cost model or revaluation model. If you following cost model, if the decommission liability increases, the PPE will increase. If the decommission liability decreases, the PPE will decrease. If the PPE value is less than the decrease amount, that will affect to P&L account as a direct cost. In the revaluation model, we already following the PPE at a fair value. So if liability increases, you cost to P&L. If the liability decreases, you cost to P&L. Even though if the revaluation surplus is less than or more than the provision account, the balance only you have to pass the P&L account. If the carrying value is 0 or else revaluation surplus account is 0, in that case directly you go to P&L account. I hope you understand this. How we follow decommissioning liability under Appendix A to IND AS 16 cost model or revaluation model, and how should you treat these increase and decrease. Either PPE will exist or PPE does not exist, and if it is exists, you should increase the PPE. If it does not exist, you go to the P&L. And in this model, existence of the revaluation surplus account or not. If the revaluation surplus is sufficient to account this liability, you directly give that liability increase to the revaluation surplus account. If it is not, if it's sufficient, you give revaluation surplus account. If it is not sufficient, balance you go to P&L account, because you should not involve PPE in the revaluation model because it's already valued at fair value or market value in the revaluation model. I hope you understand this. And then the final part, this is not in the syllabus for IND AS 16 uh, for finals or IPCC guys, but still it should required for MCA MCQs. But for MCQs, they may ask. I will filter the very good examples in differences between IND AS 16 and IND AS 10. In IND AS 16, if PPE is retired from active use or held for sale, in that case there is a separate standard in the IND AS 16. So you should transfer this liability to this standard. I mean, as per this standard, you should apply. And for this kind of transactions, IND AS 16 does not deals with the treatment, but in India as 10 there is no such treatment, so it still has to fall under the PPE only. If you held for sale, you can go to the India as 5, but under India as 10 in normal accounting standards there is no separate standard for assets held for sale, so you should maintain that as a PPE only. And then the stripping cost or removal soil or rock or wasting before the extracting minerals, these kind of concepts explicitly deals with in this standard. How do you do the future cost and all? Now also we have discussed it, right? Appendix A and all. How you deal with and all. It has discussed in the India session, but In India AS 10, there is no such clarifications. India AS 10 doesn't deal with that. This is an uh, lists the inconsistencies. Suppose some they treat the P&L account, some they treat to the revaluation surplus account, some they treat to the PPE asset. So there should be inconsistency in the corporates because of the uh, that particular concept is not available in standard. If that concept is included in the standard, they should follow as they require the standard. So the consistency will come. And then commercial substance in exchange or fair value, it is practical and all these commercial substance concept have been addressed in the Ind AS 16 but not addressed in the Ind AS 10. What is the uh, if it is not addressed in this standard, because if standard is tells how to account, then all companies will do that only. If it is not tell that, most of the companies will follow their own method. If they follow their own method or their own principles, then the inconsistency will come to the financials users. That is why Ind AS 16 will give more consistency than AS 10, because most of the doubtful finds in the standard has been discussed. This says about what is the commercial substance and how should we treat the fair value, what is the practical situation and all. But India S 10 doesn't deal with it. Detailed decommission and restoring accounting, Appendix A, just now we have discussed. In this, not discussed. And Appendix A, subsequent liability and the revaluation model, it is clearly addressed. It is not addressed. And then provision of revenue based depreciation clearly address that. And on the revenue in the depreciation method, you should not use the depreciation method on revenue base. But here they didn't address that point, or they keep silent in this. Component accounting, it is addressed, it is not addressed in the India system. So these are the main changes. There are several changes also. Additional disclosures as required as per India 16. Minimal disclosures as per India 10. So like, say suppose in India 16 the disclosure point is 30. In India 10 the disclosure point is 12 only. Like that. There is few disclosure effects will come. And then the main difference in India 16 and IAS or IFRS or IAS 16. This is the testing period proceeds. If you sell any asset under there are some sale process under the testing. In India 16 specifically says that there is no income it in the P&L. You should reduce the testing proceeds and show the net PPE only. Say suppose your PPE value is cost is 10, but you have tested that product and during the testing you got 1 lakh. That 1 lakh should reduce and balance has to show the PPE. This we clearly discussed in the part 5 and all, what how we test and all and everything. But in IAS 16 or IFRS 16, they didn't consider this 1 lakh as a reduction. So they did that reduction directly to income, and they show PPE remains at 10 lakh. This is the difference between India 16 and the international standards. If you follow any US accounting or Indian accounting and all, this is the main difference between India 16 and the IFRS 16. So, say suppose if your company parent or looks at USA related results, so this would be helpful for you. But this is not in our syllabus, but I am telling for the future purpose. So this is how the testing proceeds, you should not reduce sale proceeds from testing. You should not reduce in IAS 16, but in India 16 you should reduce it. So this is just for the understanding of purpose. And if you feel we are putting efforts in this, you please subscribe our channel and you give these details to your friends and all. Also please subscribe our channel for future updates. In this we have completed in the AS 16 property plant and equipment. We will start next standard in the another standard in the next classes. Thank you.